Thanks everybody for joining today. I'm really excited to have you guys here. I know that as employees of Workday, we have some very complicated compensation packages, and so especially around tax time, I know I always have a lot of questions in regards to taxes and our RSUs or our stock options or whatever we may have. So I'm going to hand it over to Alex, the experts, and let them treat you to some really great advice. All right, hand it over to you, Alex.
Awesome, thanks, Chanel. Well, first and foremost, welcome everyone, and thanks for joining today's concentrated positions conversation. A big thank you again to Chanel for your partnership in bringing this event to life. And I also want to give a shout out to Vamsi Rao, who is both a Workday employee and also the husband of a Summitry employee. And I know Vamsi was really helpful in getting the word out about today's event, so I wanted to thank Vamsi as well. With that said, I speak for the entire Summitry team in saying how excited we are to begin this relationship with Workday. And again, huge credit to Chanel and Vamsi for making that happen. Okay, great. Let's go to the next slide. We'll do quick introductions to both today's speakers and then also to Summitry as a firm, for those of you who don't know us. My name's Alex Katz. I'm one of the partners at Summitry and our Chief Growth Officer. And I'm joined today by my colleague, Alex Leitzis, who is one of the principals of the firm. And you're welcome for making it very easy for you that we just brought two Alexes today. So we'll keep it simple. Seriously though, about our firm, Summitry is a Bay Area based, but really more importantly, Bay Area focused independent wealth management firm, which basically means that we spend our days helping folks like all of you navigate the challenges and opportunities that come with life in this unique place that we call home, meaning the Bay Area. And whether that's navigating the crazy real estate market or helping clients think through strategies for their RSU income, the Bay Area is just full of unique financial planning situations, and that's the work we do. At the end of the day, really, we do two things though. One is financial planning, as I just mentioned a second ago. And then number two is portfolio management, which is really building portfolios specifically engineered to support our clients' financial plans. So that's who we are, and more importantly, who we help. And it, of course, dovetails right into the topic for today, which is how we help clients think about concentration risk and diversification out of some concentrated positions. So before we begin, very quick housekeeping item. You'll see the Q&A button on the bottom of your screen where you can submit questions. Please feel free to use it early and often. We'll save a bunch of time at the end for Q&A, and we'd love to hear from you. So thanks in advance for submitting questions. And with that, let's just get into it. So actually, one more thing. Please know that our commitment, whenever the Summitry team presents on any topic, is to accomplish really two things. Number one is it's going to be an educational conversation. This is not a sales pitch today. You're here to learn, and we intend to deliver on that. And then number two, we're going to do our best to not put you to sleep. But if it does happen and you do fall asleep, I just want to get ahead of it and blame the other Alex for putting you to sleep. So, so just know that that's the only possibility why you could fall asleep now. So with that said, we're gonna start with some context setting and give a framework on how to think about concentration risk and diversification. Then I'm going to turn it over to Alex to cover really the, let's call it, educational section, explaining a number of different strategies and tactics that we might deploy to help a client diversify. And then I'll close it out with an actual client story, sharing how we use a couple of these tools to accomplish our clients' goals. And then, as I mentioned, we'll do some Q&A. So that's the game plan for today. So with that, let's get into the context setting. We can go to the next slide, thanks. When a new client comes to us looking for solutions for their concentrated stock position, we do not immediately jump into tactical solutions. And I really can't underscore this enough. How we address one's position is entirely dependent on the client's overall financial plan, which basically means what is the client what does the client want to accomplish financially in the next, let's call it decade? What's their tax situation in the next 5 years, and a slew of other factors that influence what strategies we'll deploy for any given client. So while it's tempting to listen to today's talk and go straight into solution mode, and many of you will do this, even though I say this at the beginning, I caution you from doing so without the context of a financial plan. All of the factors on the screen and many, many more are part of this comprehensive financial planning exercise, which again, really must be completed before we get into the tactical solutions to support that financial plan. So just some important context setting, and now we'll get into a little bit of a primer on diversification. So let's go to the next slide. So again, very basic, but I think it's really important that we're all on the same page here when we talk about concentration and we talk about diversification. So on the left, you'll see a pie chart representing a portfolio with a highly concentrated position, making up about 75% of this individual's liquid wealth. To the right of that, you'll see a pie chart showing a diversified portfolio. Now, concentrated positions can sometimes be a great wealth creator. It's very much a, let's call it swing for the fences kind of an approach. And every once in a while, when you're swinging for the fences, you can hit a grand slam. Of course, we all know that when you're swinging for the fences, you have a higher likelihood of striking out than when you're, let's say, going for consistent singles and doubles. So the approach on the right attempts to moderate risk and consistently hit those singles and doubles. And any baseball fan out there can tell you that consistently hitting singles and doubles can still get you into the Baseball Hall of Fame. So with that, I'm going to end my baseball analogy, but hopefully the point resonates that there are pros and cons to concentrated risk or concentrated positions. There are pros and cons to diversification. Now, on the right side of the slide, this attempts to answer the question, how much diversification is enough diversification? Well, there's quite a bit of academic research out there that shows that once a portfolio holds 20 to 25 different stock positions, and you can see that represented by the vertical tan bar on that chart, well, once you get to 20 to 25 different stock positions, you've reached a point of diminishing returns from a risk mitigation standpoint. However, there's a huge caveat to that number. The correlation between those 20 to 25 stocks matters deeply. So it's not enough to just own 25 stocks. It matters which stocks you own. So for instance, if you own 20 to 25 stocks and they're all, let's just say, Bay Area-based tech firms, which we see all the time in new clients' portfolios when they come to our firm, then you haven't really done much to achieve your goal of diversification. So again, one more time, the point is the composition of those stocks matters quite a bit when you're constructing a portfolio. Now, we've been talking to folks like you about diversification and concentrated positions for many, many years. And fortunately, we've been able to help protect many Bay Area tech workers from exactly what is happening in the market right now. But the next slide is one that I added to this deck a couple of months ago because all of a sudden, concentrated risk went from something people academically understood to something that really became part of many tech workers' realities. So we wanted to show a snapshot of some of those realities. Now, you can see a few different companies up here. We work with employees at all of the companies on the screen, as well as Google and Meta and NVIDIA and you name it. And they're all great companies. But this slide really exemplifies what market volatility can mean to employees who not only get their paycheck from these companies, but also hold a significant portion of their personal wealth in company stock. So this slide shows, number one, the degree to which volatility can impact wealth. Number two, the speed at which it can do so. And number three, the different ways it can really play out. So again, obviously all three of these instances that you see up on the screen took place in a relatively short period of time and were pretty significant drops. But compare the drop in Pinterest share value, which was a gradual repeated downtick over many, many months, to what happened with DocuSign, which had one bad earnings call and the share price just dropped off a cliff. So it can happen in a bunch of different ways, but a question that we frequently ask new clients when they come to our firm and they've got this big concentrated position, let's just say for argument's sake, they've got a $4 million stock position in their company stock. A really interesting question that we ask our clients that you could ask yourself is, how much would it impact your financial future if that $4 million turned into $8 million? Now, on the flip side, what if that $4 million turned into $2 million or $1 million? How much of an impact would that have on your financial future? Frequently, people can't see the downside until after the fact. And that's why we wanted to include some real world examples here, really just to showcase that what we're talking about today isn't just academic and theoretical. And of course, you all know this because while Workday is a terrific company and the stock tripled between 2017 and this time last year, November of 2021, since then, there's been about a 50% pullback in the value, just like many other tech names in Silicon Valley. So this is not theoretical or academic to many of the folks on this call as well. We appreciate that. Okay, let's go to the next slide. And we're going to talk a little bit about how we approach diversification, how we approach calculating the risk within a portfolio. So when a new client comes to Summitry, we do some pretty sophisticated analyses of their current portfolio, really quantifying the risk and the diversification structures within the portfolio. So this slide shows the output of one of those analyses. And in this tool, all portfolios are given a score of 1 to 99 for risk, 99 being the most risky, 1 being the least. And just for context, a portfolio of all cash would have a score of 1. If you owned, let's say, just the S&P 500, a S&P 500 ETF, that would give you a score of about 76. And then at the other end of this extreme end of the spectrum, let's say you had all of your entire liquid net worth in Tesla stock, that would probably be a score of about 99, given the stock volatility for Tesla. So that gives you some context of what these 93 and 92 that you see up on the screen means. But let's look at the left for a second. So looking at this chart on the left, the bands in the circle around the perimeter of the circle represent the size of each position and its correlation with the other positions in the account. So dark green means highly correlated. And then blue, which we don't see any in this chart, but blue would be anti-correlated. As you can see in this example, and this is a client who happens to work at Facebook and still does work at Facebook, but this is what his portfolio looked like when they joined us. There are some very large positions in the portfolio, and there's a lot of dark green on the correlation chart. So the great part of this software that we use is that we can really quantify the diversification benefit in this portfolio. So by that, I mean, now we're kind of moving over to the right side of the slide, and we start by looking at a weighted average of all of the individual risk scores of the positions in the portfolio. And in this case, that resulted in an overall position risk score of 93. Again, that's just a very simple weighted average. It doesn't consider correlations at all. Through diversification, this client has only decreased their overall risk by 1 point down to a score of 92 from the weighted average of 93, which is to say there really isn't much diversification benefit at all that this client's getting. Now, if we go to the next slide, we'll show you the Summitry portfolio that we built for this client. You can tell that visual looks very, very different. This is still, it's important to note, this is still an all equity portfolio. So you can see on the left, the positions are much smaller overall, and equally, if not more important, you can see that there's much more light green and even some blue, meaning that there's much less correlation between the stocks in the portfolio. So we were able to reduce the risk from a weighted average, in this case of 88, down to a risk score of 58. So it's a 30-point reduction in risk due to diversification. I will just note one more time, all equity portfolio, it's got a risk score of 58. Compare that to all equity of owning the S&P 500, which would have a risk score of about 76. So we're able to be very thoughtful in the way we reduce the risk in a portfolio. So again, I'm belaboring the point, but the composition and the correlation of the actual stocks in the portfolio is just so critical to the overall risk profile of the portfolio itself. So with that, that's a very, very quick introduction to how we think about risk and diversification. And again, it's just setting the context for the meat of today's talk. But before we get into that next section, I want to repeat one more time that once we've decided that there is a concentration risk in need of addressing in the client's portfolio, we absolutely must contextualize any strategy for diversification within the client's financial plan. And what we've listed on this next slide are some of the major considerations that we take into account when we're looking at diversification approaches in a financial plan specifically. So you see your liquidity needs and your capital gains and tax impact and stock trading restrictions if you're still employed by the company whose stock you hold. And of course, charitable aspirations and gifting strategies can be key to this. And there are many, many others that come into effect when determining the best strategy for diversification. But really what we want to point out here is this is just a very multifaceted decision-making process. So with that foundation laid, and hopefully that sets some good context for where we go from here, we'll now walk through 7 of the tools in the proverbial tool belt that we use to help our clients diversify out of their concentrated positions. Note that in many actual client cases, we'll deploy multiple different strategies to solve for a client situation. And you'll notice in the example that I share at the end of today's talk that we used at least 2 of the different solutions. So with that, I'm going to hand it off to my colleague, Alex Leitzis, to dive into the more educational side of, number 1, what these strategies are, number 2, some pros and cons of each strategy, and number 3, who each strategy might be appropriate for. So with that, Alex, take it away.
Thank you, Alex. I appreciate you setting the stage for us, the education portion of this. And as all of you recall, he said so nicely, this is the time for all of you to fall asleep. So I'm excited that the bar was set so high here. But if I can do anything to not put you to sleep, maybe it'll be a really lame dad joke, if you will, that this is the one proverbial belt that we're looking to expand, while other waistlines we're usually looking to decrease. So we're going to discuss 7 of those tools in our tool belt. And as Alex mentioned, it's timely, right? We know that this market environment is challenging. And the reality is, with respect to a lot of these different strategies, they may be more or less appropriate given the current market environment that we're in. So as I dive in here, I'm going to share a little bit about each of the strategies. I'm going to share the pros. I'm going to share some things to consider, and I'm going to talk about who they might be most appropriate for. So here are the 7 strategies, and we will go through them one by one. And let's go to the next slide, please. So the first strategy I'm going to discuss is, as they say, the oldest trick in the book. It's tax-sensitive strategic selling. For most firms, this is the one and only strategy that they'll implement for clients with concentration. And candidly, it's the oldest trick in the book because generally it does play some sort of role in your overall strategy to divest. It's really dependent on how much, and that's going to be case by case. You know, this strategy allows for you to be very tactful. It allows for you to be considerate of how much you're going to sell, how much in gains you want to incur, what particular lots you want to sell. And it allows for the most direct strategy of going from concentration to diversification with a prudent reinvestment strategy. There are, however, things that you do want to be considerate of. Things like, well, if you're going to incur capital gains, those are unavoidable. I will leave that with a caveat. There are some strategies to help mitigate or offset, but by and large, when those gains are incurred, you have to come up with some strategy around paying those taxes. And as is the case with all of these strategies, but I'll say it now as we go through the first one, there is potential for opportunity cost, right? If a particular position we're selling out of goes up meaningfully during a short period of time, you may be at a short-term a negative delta there with respect to the gains on that particular individual security. But by and large, these strategies we're implementing are more often long-term strategies for our clients in terms of achieving diversification. If we can move on, please. So next, I'm going to talk about exchange funds. Exchange funds are a privately offered fund designed to essentially swap your concentration for a diversified, mostly equity-focused strategy. I say mostly equity because they're about 70% equity focused with and about 30% exposure to real estate. They're benchmarking the exchange funds benchmarks against some common indices, things like the S&P or the Russell 3000. And this strategy really allows us to eliminate that idiosyncratic risk, which comes when you predominantly own one particular stock. Essentially, the benefit of these private offerings is you take that concentrated position, you swap it for the diversified basket, and you don't pay the taxes in that moment. But this is a strategy to kick the tax can down the road. It doesn't reset your cost basis. And as we look at some of the things to consider here, I will spend a moment there talking about that tax basis. Essentially, let's say you have $1 million in a stock that you put into the exchange fund with a $100,000 cost basis. If you utilize the exchange fund for, let's say, the 7-year period of time, or even furthermore into the future, whenever you decide to get out of the exchange fund, you are given back your original cost basis. You're given some options as to how you're going to take that, but your original cost basis does stay at $100,000. As is the case with any premium offering, you'll hear me say this a couple of times throughout today's educational section, there is an additional cost to the exchange fund. There are only 2 games in town, and they're very aware of that. And so there is an additional cost that comes with accessing the exchange funds. Also, not all equities are accepted, right? Because they're trying to mirror an indice. If there's one particular stock that they're overloaded with, they will limit the access for a particular security at a given time. You also need to be an accredited and qualified investor, and we can certainly talk more about that where appropriate. And the minimums fall somewhere between $500,000 and $1 million for the exchange funds. And lastly, as you'll see with some of these ancillary offerings, there are certain time frames where you will need to be in the fund, or there is penalty, or you need to be in the fund to access the full benefit of the strategy itself. So next, we're going to move on here to qualified opportunity zone. So qualified opportunity zones were added to the tax code thanks to the Tax Cuts and Jobs Act of 2017, I believe, which essentially stated that certain economically distressed communities where new investments under particular conditions may be eligible for preferential tax treatment. And so essentially what you're able to do is take the appreciated value of your particular, in this case, individual stock, right? If you have something worth $500,000 and you paid $100,000 for it, you're able to take the capital gains, put it into the qualified opportunity zone or QOZ, and defer those taxes. And at certain aspects of the future earning gains, those are tax-free. So if you utilize the exchange fund for the intended purpose or allotment of time that you're in the fund, you will be able to take those future gains tax-free. Another opportunity here or benefit of the qualified opportunity zone is diversification, right? You're getting access to some investments that generally aren't offered to the common investor, right? A retail investor may not have access to multi-unit properties or commercial real estate. And so this is another way to get some appropriate diversification within your investment strategy. Additionally, it doesn't work on a calendar year. You actually have 180 days from the realization of the gains to execute on the strategy. So even if you were to do it sometime in Q4 of 2022, you don't have until December 31st. You actually have almost 6 months out to date, and you can reconcile that with the IRS, which we can certainly be of help with, and of course the CPA can as well. And again, just like the exchange fund, some considerations here are that there is a time period where the investment is locked up. There are portions of after a certain period of time where income can be distributed off the qualified opportunity zone, so it isn't 100% illiquid. And as is the case with the exchange fund as well, there are a handful of games in town. This being an ancillary premium offer, there are additional management fees that come along with it. And as it was intended, right, these are economically distressed areas, so there is going to be some sense of development risk there. We do our due diligence, spend a lot of time as our research team vetting the different offerings, but nonetheless, these are investments in and of itself, and there is some risk associated. And lastly, just another wrinkle of life in California. A lot of states conform to allowing you to defer the capital gains from a statewide level. Unfortunately, California does not. So when you utilize the qualified opportunity zone and sell your highly appreciated asset, while you can defer the federal capital gains, you will have to pay for the California specific state taxes associated with the gains there. If we can move on in. So next, we're going to spend just a really brief moment on options overlay. I want this to be relevant, and I'm doing my best not to put all of you to sleep. And so a strategy like an options overlay, candidly, it isn't overly appropriate for most Silicon Valley clients or the companies they work at. So in the interest of keeping this relevant, I'm not really going to spend too much time on this strategy. If we were talking to a team at Coca-Cola or Procter & Gamble, this may be more appropriate. But really, at a very high level, the 10,000-foot view, an options overlay strategy is designed to enhance total return and generate incremental income, and is really most appropriate. And I want to emphasize this, a more predictable stock, as I mentioned just a moment ago. And the reason for that is there's three major components of the option strategy. It's volatility, time, and stock price. And as Alex mentioned, as we gave some examples earlier, there are certainly some stocks where this may be more of a detriment than a value to your overall investment or diversification strategy. So with that, we will move on. So now we're going to spend a couple of minutes here talking about a collar strategy. A collar is a strategy you might bring to bear if you're concerned about negative volatility around a particular stock of yours. Again, I won't belabor the point there. And essentially what you're doing is you're wrapping your underlying stock with a collar using options. You're trying to protect your investment from downside risk, but also in doing so, you have to be willing to give up a little bit of the upside potential above what's called your short call strike. There are three parts to a collar strategy. You own the stock, you buy a put, and you sell a call. To further explain each component, clearly you own your underlying asset. Number two, in order to protect that investment, you'll need to buy a set of put options at selected strike prices below the current price of your stock. This essentially marks the floor for which you can exercise your put. And then lastly, you're able to finance the put purchase with the sale of the call options previously mentioned that are above the current price of the stock, or called the strike price. This price marks the ceiling. Dependent on the call option you sell, the premium can finance all or a portion of the put price. So essentially, if you sell the call option, you're obligated to sell your stock at the ceiling price. So if you have no intention of actually selling the underlying stock position, it will be a critical part of the strategizing around the collar that we'll want to do, and we'll likely want to make sure you have some liquidity on your balance sheet to keep from essentially calling out or selling off the initial stock that you put into the strategy. And if you're going to take anything away about this collar strategy, remember, you're capping your upside, but more importantly, you're protecting your downside in doing so. And the premium you collect from the out-of-money call option generally, in most cases, should cover the cost of buying the put. So let's move on to our charitably inclined options. And first and foremost, I want to be very candid about this. Being charitably inclined is absolutely a personal decision. Some folks want to do it throughout their lifetime. Some want to leave it to their heirs to make that decision with respect to their estate. Some want to do it specifically when they pass, and others say, hey, look, if there's a benefit from a tax benefit standpoint, I'm certainly happy to consider the options. And again, something we'll learn more as we do our due diligence and learning more about your financial situation. So the two options I'm going to introduce today are a donor advised fund, or a DAF, and a charitable remainder unit trust, or a CRUT. So let's spend a moment on the donor advised fund. Essentially, this is a charitable investment account. What does that mean? It means you get to put assets into a trust specified for one or a subset of different charities. When you make the contribution, you're eligible to claim an itemized tax deduction for your federal or state tax income purposes. And the benefit of that is you can make a significant decision, as Alex will speak to shortly, to say putting a couple $100,000 into said donor advised fund and utilize the charitable payments for many years ahead, sometimes even decades, but take advantage of that significant tax benefit in one particular tax year, which is something we'll often utilize to offset things that we talked about earlier, like tax and strategic selling, which you'll get a primer for here in just a moment. Some considerations are the contributions do need to be made to a public charity or a 501c3. The funds can be invested for tax-free growth, which is great, right? So you can contribute to the DAF, receive the tax break, and allow for the funds to grow tax-free. So you're making even larger contributions if you're someone considering this for a long-term charitable intention strategy. And so the second strategy, while I would say a donor advised fund is merely and solely a gifting strategy, there's a couple other wrinkles to the charitable remainder unit trust. So a CRUT is a trust that provides income to a named beneficiary, or it can be multiple beneficiaries, during the grantor's lifetime, and the remainder of the trust goes to charity. So the CRUT is a trust which can do a multitude of things. One of the common benefits, especially to our clients with highly appreciated positions, is you can place the highly appreciated asset into the trust, sell the position within the trust, and not pay any capital gains. You only pay capital gains on the trust upon distribution, which is something we set up on an annual basis. We'll utilize a partnership with the estate planning firm that we work with, and essentially create either a certain period of time or a lifetime of income for you and a partner, or whoever the said beneficiaries are in this case. And so without going into too much of the nitty gritty, some of the things that we're going to give consideration to are life expectancy, your income needs, the tax benefits, which are based on both of those things I just mentioned, both the amount of income you'll need and your life expectancy, to determine the specific stipulations of the trust. And ultimately, though, it's intended to allow for you to diversify a highly appreciated asset, defer the taxes until the trust starts paying the annual lifetime income, and affords you that immediate tax break with the proceeds going to the trust or trust of your choice. So hopefully I did my best to not put all of you to sleep. And if I did or didn't, story time is coming up now from Alex, so he's certain to put you all to sleep at that point.
No, wake everyone back up. How dare you? How dare you, Alex? And I will just share this. I don't know how many Workday folks are working from home. I assume many of you, but while Alex was talking, the reason I had to turn my camera off is because my dog does not respect the closed door of the webinar. I think he knows when I'm speaking on webinars, and I think he somehow managed to start the dryer also just to make some extra noise. So it got a little loud in here for a second, but anyway, Alex, thank you for covering all the educational part. Cool. Yeah, as we said, let's shift gears and do some story time. So we're going to share a case study of an actual client where we use just two of the diversification strategies that Alex just talked about to accomplish what was needed in this client's balance sheet. It happens to be the first diversification tool that Alex talked about, and then the second to last one, the donor advised fund. So this story goes back about 3 years, and of course I've changed the client's name to protect the innocent, but we'll hop into it. So let's just call this client Steph Curry, because it's not Steph Curry, but I think we can stick with Steph. All right, so in this case, Steph is a single guy. He's in his mid-50s. He's worked at NVIDIA for almost 18 years. And he came to Summitry with about $8.5 million in NVIDIA stock, which was all resulting from RSUs and ESPP purchases. About half of the $8.5 million was vested RSUs and ESPP, and then the other half was unvested. Steph didn't know how to think about taxes. He didn't know how to think about concentration risk. Admittedly, he had not been paying much attention and just hadn't been, as he put it, responsible about his balance sheet concentration. He's a really interesting guy. He's a pilot. He plays a bunch of musical instruments. He's an active gamer, not surprising as an NVIDIA guy, but just has a ton going on in his life and doesn't pay a ton of attention to what a CFO for someone's life would pay attention to. And that's really where we came in. Interestingly, in our financial planning conversations with him, it came up that Steph gives about $30,000 a year to charity. But it happens to be the same 4 or 5 charities every year, but he just writes a check to those charities, which is about the most tax inefficient way to make that gift. So there was a big opportunity there. So let's cutting to the chase. The solution that we put in place here was a relatively simple one, making use of, again, just 2 of the tools from the aforementioned tool belt. So those tools were tax sensitive selling and the use of the donor advised fund. And again, the DAF, as we call it, donor advised fund, allows us to accomplish 2 things. Number one, to gift to charities in a much more tax sensitive way. And then number 2, what was relevant here, to create an offset from this large donation to the DAF, a tax offset in the year in which the gift is made, to some other tax consequences or tax burdens on the other side of the ledger. So I'm going to show you the work that we did in the background. We can go into the next slide. And this will really give you a sense of the kind of analysis that we did. So I get it. This is a sea of numbers and colors, and probably many of you can't even make out the numbers that are on the slide here, but I'll try to bring this to life. This was the analysis that we did of just Steph's vested RSUs. So what you can see, let's go to the next slide. I'm zooming in here. What you can see just going across the top is you have the grant date, you've got the quantity, the price, the cost per share, market value, cost basis, gain loss. And then the most important column, or one of the most important columns, is the one that you just see green here, the gain loss percentage. And then continuing to the right, the holding period, and then our recommendation. So we'll go to the next slide and kind of zoom back out. Remember that gain loss column is 3rd from the right. You can see that's where we have the conditional formatting happening. So what we're really showing are the shares which have the least gain at the top in green, 34% gain in those shares. And then at the bottom, the shares with the most gain, most unrealized gain. And you can see at the bottom, some of those have over 2,000% gains in those shares. So very simply, the way to think about this is there is much less of a consequence from a tax standpoint to selling any shares at the top of the range because they have less of a long-term capital gain than selling anything at the bottom. Whereas there's a lot more benefit to donating the shares at the bottom into a donor advised fund because you're getting a huge benefit of not paying those taxes and still being able to donate all of those shares to charity and getting that tax offset. So let's run through the numbers. We'll go to the next slide and show you exactly how this played out for Steph. So as I mentioned, he had about $4 million invested RSUs in NVIDIA stock. The short-term value, meaning shares which they had vested within a year, was $1 million. So we took that $1 million off the table to begin with, and really we were just looking at the long-term capital gains. So we've got just under $3 million of long-term or of shares with long-term capital gains. Our recommendation was to sell about 1.33 million of the 2.9 just in a taxable account. Those would be the shares toward the top in green. And then to gift $452,000 to a donor advised fund, those would be the shares at the bottom of the chart in red and orange, and get that big tax offset. Now, some of you may be saying, wow, $452,000 as a charitable gift. I thought you said this guy only gives $30,000 a year to charity. So how does that make any sense? Alex mentioned this, but I'm just gonna say it one more time because Alex said a lot. In this case, the client, and in any case where a client is making a gift to a donor advised fund, you make the gift of the $450,000 in year one. And in that year, you get the big tax offset. That doesn't mean that you're gifting it to charity in year one. So in this case, what Steph was doing was basically pre-funding 15 plus years worth of his charitable gifting, but getting a huge tax benefit in the year in which he's going to have a big tax bill. So we're creating the offset. So continuing down the slide, I think I left off at the 452,000 gifted. The remaining position still in NVIDIA stock was about 2.2 million, which means we reduced his concentration risk by 45%. Now, the gains on the sale, the taxable sale, were $740,000, which under normal circumstances would lead to a $275,000 tax bill, as you can see on the next line down. The offset feature comes from that donor advised fund. So as you see, the $452,000 as a gift into the DAF, you get 50.3% of that as a tax credit. So $227,000 offsets the $274,000 tax bill, which basically means that Steph was left with a $47,000 tax bill, as you can see in the bottom line, having sold out of a significant percentage of highly appreciated positions. So really what this shows is a very simple example of how using just two of the tools in the tool belt can allow you to accomplish significant diversification and do so while minimizing taxes and taking care of another ambition that in this case this individual had of doing some nice charitable gifting over the course of his lifetime. So hopefully that brings all of this to life just a little bit more and how these pieces can fit together. Let's go to the next slide. So this next slide is really just a framework for how we think about decision making, and I'm sure many of you have seen this similar matrix for decision making. So you've got every decision falls into the category of how significant it is versus how frequently you make it. And the idea here is on the vertical axis, the most significant decisions are towards the top, the least significant are towards the bottom. On the frequency scale, on the horizontal axis, you've got very frequent on the left, you've got less frequent on the right. So high frequency, low significance would be, which laundry detergent I'm going to buy at the grocery store this weekend. This decision that we're talking about today of how I'm going to approach diversification out of this highly appreciated position in my portfolio is the antithesis of that. It is high degree of significance from a personal net worth standpoint and financial impact standpoint. And it's generally a low frequency decision because you put the strategy in place only once or twice in your lifetime and then follow through with the strategy. So the reason that we share that is whether it's working with Summitry or working with someone else, those highly significant low frequency decisions are typically places where working with an advisor tends to add a ton of value. So just wanted to give that as framework for the decision. Let's go to the next slide, and then I promise we'll get to Q&A shortly. Really, what we have on this next slide, this is a little bit more about Summitry. We have scratched the surface today on the work that we do, so you can see concentrated positions, concentrated portfolio positions is in orange. There are tons and tons of other financial planning conversations that we have with our clients and portfolio construction conversations that we have with our clients. So I didn't want you to think leaving today that we're just the concentrated positions people. There's a lot more to the planning work that we do, and hopefully this just brings that to life a little bit. And then one more slide, which is really just an offer to all of you before we get to Q&A. You recall early on, I showed those kind of cool spiderweb looking visuals when we were showing the risk analysis tool. Our offer to all of you for parting with, well, let's see, we're 45 minutes into today's conversation, for parting with 45 minutes to an hour of your time today, is to do that analysis for you. And really it's a two-part analysis. The first step is, if you're interested, we would send you a risk tolerance survey, which you would fill out. And really that would just kind of give you, you can think of it as your ability to sleep at night score. So am I a 42 like Jane Smith up on the screen? Am I a 70? Am I a 15? Whatever your personal relationship with risk is, this survey does a really nice job of quantifying that. Part two, if you're interested, is then to share your current portfolio. And we can run that same portfolio through this risk analysis tool. And I'll tell you, we see this very, very frequently, that Jane Smith, her personal relationship with risk is a 42, but Jane Smith's portfolio is an 83. And so something needs to be done there in order to bring those two into alignment. So we would be more than happy to do that work if this is something that you're interested in. It's incredibly eye-opening and incredibly valuable for anyone who goes through it. You can see both of our email addresses are up on the screen here, so feel free to ping either one of us. With that said, we'll follow up with all of you, but wanted to make sure that you were able to get to us if there's urgency on your end to have that conversation. So with that,
Alex, I just wanted to piggyback because I think it's worth overstating. Not that I want to generalize that you're all engineers, but we happen to work with a lot of engineers here in the Bay Area, and they're always telling us as we go through this evaluation with them, they really want to know how things work. I can say with the utmost certainty that the software Riskalyze we use does an exceptional job of doing that, especially when we have both the survey taken and we're able to help analyze the assets, because it helps to really quantify that and does a really deep dive, as you saw earlier when Alex went through those slides. So just thought that was worth noting before we jump into Q&A.
Perfect. Thank you, Alex. So we did get a question that I saw was up there, but now seems to be, I think it's been taken down, which is somebody had joined late and was just wondering if they were going to get a recording. Yes, we will work with Chanel to get the recording out to everyone who attended here, and feel free to share it beyond just the participants as well. Question that we got in the presentation, you mentioned tax sensitive selling. What are you diversifying into? ETFs, stocks, bonds? What else? What do you end up buying for your clients? Alex, you want to start us off with that?
Yeah, certainly. So one of the things we probably briefly mentioned is that we have an in-house institutional research team, and we've got 6 core strategies. I want to emphasize core because there's going to be ancillary aspects to the strategy as well, which is why we went through today's 7 proverbial tools. And so it's going to be, it can be multi-layered, right? There's going to be a core portion of the strategy, which is going to be individual stock-based, individual bond-based, dependent on the types of assets we're managing, taxable versus non, and then certainly implementing 1, 2, or 3 of the strategies mentioned earlier. But it's, as I said, it's going to be very tactful about this approach, and the timing around it into one of our 6 core strategies is going to allow us to think more from a long-term approach when it comes to the diversified strategy for your assets.
Cool. I'll just add this to it, Alex. A big part of the reason why we don't use ETFs or mutual funds is because they generally can't be customized. And for a lot of our clients, let's say somebody from Workday hired us and they've got a big Workday position, the last thing you want us to do is buy more Workday for you, or even some other highly correlated position to Workday. So our ability to customize portfolios for our clients is just critically important for the work that we do.
Yeah, before you jump to the next question, that it's funny that you say that. One of the benefits of the exercise we just showed you with Riskalyze, I did this with a now client of ours who owned 26 mutual funds across his 2 different custodians he worked at. He worked at Meta, and 24 of the funds had Meta in it, all a US-based mutual funds and ETFs, and 24 of 26 held Meta. So I think further emphasizing your point there is critical.
Exactly. We want to be complementary to what our clients have, not redundant. So yes, thanks for that, Alex. I think this is one that you talked about a little bit, but maybe a little bit more. How long does a CRUT last? How long can I take advantage of the income stream? How does that work?
Yeah. So there's two ways it can go. As I mentioned, you could be the sole beneficiary of the income stream, or it can be a couple, two spouses, or it can be of period certainty, right? It could be, you could say, hey, I want to make sure this hits 20 years, and God forbid if it doesn't, and something happens and I only am able to assume the income for 8, I want to make sure a third party is paid out the remaining 12 years of it, and then not until, based on the stipulation, the terms through your lifetime or that period certainty, that's when the remaining portion of the assets put into the charitable remainder unit trust will be dispersed to charity.
Perfect. All right, last one we have, unless there's any other folks just waiting to build suspense to submit their question. Last one we have is just a question about our fees and minimums, and I'll handle that one just really quickly. That's a conversation we'd love to have one-on-one with anyone who's interested. Generally, we start relationships at about $1 million in assets that we are managing on behalf of our clients. So that kind of covers the minimums, although really the way we think about it is, in order for us to have an impact on our clients' financial well-being, we generally are managing somewhere in the 50 to 70% of their liquid net worth. So what's most important to us is that we have that ability to have an impact on long-term financial well-being. In terms of fees, I know that our industry, reasonably so, has gotten a bad rap for hidden fees and all of those kinds of things. And I love this question because it allows us to speak to the transparency at Summitry. First and foremost, we're a fiduciary, so we are required to put our clients' interests before our own. And as part of that fiduciary responsibility, the way we've structured our fee is to ensure that there's not even the potential for conflict of interest between our firm and our clients. So our fee is simply a percentage of the assets that we're entrusted to manage. That means assets go up in value, that's good for you, good for us. Assets go down in value, less good for you, less good for us. But that's where the alignment of interests comes in. No hidden fees, nothing along those lines. So that's the basic structure. But again, for anyone who's interested in a more specific conversation, we would be happy to. Oh, and I saw that this question just came in. I promise you, I didn't even see the question and I just answered it anyway, which was, are you a fiduciary? So thanks for that question, appreciate it. For those of you who aren't familiar with that distinction and why that matters, I mentioned it, but that means that we are legally bound to put our clients' interests before our own. We can't have hidden fees. We can't have any of the malfeasance that happens in our industry. Very different from a broker dealer, like let's say Merrill Lynch, or you name the big box broker dealer out there. Some of you may recall that the DOL a couple of years ago wanted to change the structure of the broker dealer relationship and make them fiduciaries. And the broker-dealer industry fought that tooth and nail and actually won and never became fiduciaries. Whereas as an independent wealth management firm, we're technically a registered investment advisory firm, we have been, always will be, and very much want to be fiduciaries for our clients.
Yeah, I think there's kind of quantify an example there, Alex, with a broker-dealer, for example. If they believe that a certain fund were suitable for you, right? Let's say a large cap mutual fund was suitable. They may have 3 different funds that they can choose from, all with different expense ratios, all with different payment structures for said broker dealer. There is nothing that says that they have to pick one over the other. So back to Alex's point about conflict of interest, we're always doing our best to avoid or eliminate at all costs.
Absolutely. All right, I don't see any other questions. We're coming up on the hour. I just want to thank everyone one more time, because parting with an hour of your day middle of the day when we're all suffering with Zoom meeting fatigue and webinar fatigue, now not quite 3 years into this work from home situation. I just want to thank you all for staying with us and for your attention and questions. We're more than happy to have follow-up conversations with anyone. We'll reach out just to make sure you have our contact information. But again, Chanel, big thank you to you. Vamsi, thank you to you as well. And we'll look forward to future conversations. Thanks very much.
Thanks, everybody. Take care.